Hello everyone, and welcome to our session on the basics of taxation in India. India's taxation system is broadly categorized into direct and indirect taxes. The power to impose these taxes comes from Article 246 of our Constitution, combined with the 7th Schedule, which carefully divides taxing powers between the union government and the individual states. Let's begin by exploring direct taxes. These are taxes levied directly on an individual or organization, meaning the person paying the tax to the government cannot pass that cost on to anyone else. They are typically based on income, wealth, or profit. A key characteristic is that both the incidence, who the tax is aimed at, and the impact, who actually pays, fall on the same person. Direct taxes are calculated based on the taxpayer's ability to pay, so generally, higher income means higher taxes. Common examples include income tax, which varies by income bracket, transfer taxes like estate or gift taxes, property tax on land and buildings, capital gains tax on profits from selling assets, and corporate tax, also known as Nigam Kar, which companies pay on their profits. Direct taxes offer several advantages. They promote equality since they're based on income, helping to balance society economically. They can also curb inflation, as the government can adjust rates to manage demand. There's certainty for taxpayers, as the amount is typically determined in advance, and they're economical to collect, often via automatic payroll deductions. However, direct taxes also have disadvantages. They can be evadable, sometimes earning them the label tax on honesty, if false returns are filed. Heavy direct taxes can discourage savings and investment, potentially harming the economy. And because not everyone pays them, they can sometimes lead to social friction, or a sense of unfairness, among different groups. Now let's turn our attention to indirect taxes. Unlike direct taxes, these are not levied directly on income or profit, but rather on the expenses people incur, and crucially, they can be shifted from one taxpayer to another. Typically, they're levied on sellers of goods or services, but the sellers pass that cost on to consumers, who then indirectly bear the tax. A prime example is GST, which is added to the price of a product and paid by the consumer. Indirect taxes are often hidden within the price, so consumers might not even realize they're paying a tax. Here, the incidence on the seller and the impact on the consumer fall on different persons. Besides GST, other examples include sales tax, service tax, VAT, excise duty, and customs. Indirect taxes have their own set of advantages. Everyone contributes, as anyone purchasing a commodity pays the tax. They are convenient because the tax per transaction is often low and hidden, making them feel less burdensome. They cannot be easily evaded, as buying the good means paying the tax. And since they are spread across a wide range of products in small amounts, they are a broad-based way to collect revenue. However, there are disadvantages too. Indirect taxes can be regressive because everyone pays the same amount regardless of income, which can disproportionately affect lower-income individuals. They also raise the price of commodities for consumers, and in some cases, they can contribute to inflation. Moving on to key financial documents and funds, let's briefly look at 5 important ones. First, the annual financial statement or budget document is mandated by Article 112 of the Constitution and details the government's revenue and expenditure. Second, the Finance Act is the legislation that enacts the taxation proposals outlined in the budget. Third, the Appropriation Act authorizes the government to withdraw funds from the Consolidated Fund of India for its expenses. Fourth, the Consolidated Fund of India itself is the primary fund into which all government revenues are deposited and from which most expenses are met. Finally, the Public Account of India holds funds like Provident Fund contributions, which are not subject to parliamentary approval for withdrawal, unlike funds from the Consolidated Fund. In terms of financial oversight, 2 key bodies stand out. The Comptroller and Auditor General of India, or CAG, is responsible for auditing government accounts, ensuring financial accountability and public spending. Then, we have the Finance Commission of India, constituted every 5 years under Article 280. Its main role is to recommend how tax revenues should be distributed fairly between the central government and the states. The Indian Constitution, specifically Article 246 read with the 7th Schedule, plays a crucial role in center-state financial relations by clearly distributing taxing powers. The Finance Commission further strengthens this relationship by recommending equitable tax revenue distribution, ensuring financial balance and federal cooperation. This entire system provides a robust framework for India's taxation and the fiscal ties between different levels of government. A major reform in indirect taxation was the introduction of the Goods and Services Tax, or GST. This was brought about by the 101st Constitutional Amendment Act in 2016. GST is a unified tax that replaced many central and state levies, simplifying the tax structure. It's a prime example of an indirect tax applied to anyone selling goods or commodities, with the cost typically passed on to the consumer. Since its implementation, approximately 11 different taxes have been merged into GST. Finally, to oversee GST, the GST Council was established under Article 279A of the Constitution. This is the apex body for GST, responsible for making recommendations on crucial aspects such as GST rates, exemptions, and the laws governing GST. Thank you for your attention.